So where are we now? Well, Paul alluded to the erosion of underwriting fundamentals. So today we've seen the return of the risk premium. And if you're a borrower today, you've seen that in spades. Spreads that lenders are requiring on their loans have increased by as many as 250 to 400 basis points. The return of the risk premium and the end of irrational exuberance. Let's dig a little deeper on the return of the risk premium. Primary versus secondary markets. In the cycle we just came through, you could get the same loan terms on an asset located in a primary market as you could in a secondary market. Same loan to value, same interest rate, even though there's greater risk in the secondary market. Leased versus vacant space. It was a joke among investment brokers that vacancy was worth more than lease space because everybody was underwriting growth. That's no longer the case today. Turnover, same thing. Turnover was good. The market was getting better. Rents were going up. Not today. Investors today, lenders today, they want longer-term leases and they want stability. And finally, A product versus B product. You could get the same loan terms on A product and B product and generally the same cap rates, even though B product contains a lot more risk. That is no longer the case today. So this has led us to a back-to-the-basics approach for both lenders and investors. And we'll start with a look at lenders. Higher spreads equal higher borrowing costs. Lower loan-to-value ratios. In the cycle we just came through, you could get loan-to-value ratios of 90 to 95%. Today you're fortunate if you get 60%. And finally, strength and relationship with the borrower. If you're a borrower today, you better have strong relationships with your lenders or you're going to find it even tougher to secure financing for your projects. Now let's take a look at the investors. There's a focus today on unleveraged returns. Investors are no longer willing to use financial engineering to juice returns and entice them to do deals. Conservative underwriting. Let me give you a couple of examples. Market rental rates. In some cases, investors are underwriting those to be flat for a couple of years. In other cases, they're underwriting that those are going to decrease based on projected lack of demand for space. Another example, vacancy loss and credit loss. Investors are cranking those up in their models before they look at the pricing that they want to achieve. And finally, higher required returns. It only makes sense. The perceived risks are up, returns should be up, and additionally, borrowing costs are up, so returns need to go up.
So what has this back-to-the-basics approach done to value? Well, unfortunately, if you're a real estate owner out there today, cap rates are up between 100 and 200 basis points from the peak in 2007, and that's for core product. If you have riskier B product, the spread is even wider. So as you can see from this chart, the spread that we are experiencing now is much greater than in the past. As a matter of fact, we probably shouldn't have put a cap on that. We can very easily see deals trading above 12% cap rates in this marketplace due to the very reason that Mike just mentioned, the risk premium. Let me throw a statistic at you. It's a little bit complex, so pay attention. 2002, over 66% of the transactions that happened at a cap rate over 10%. 2007, fewer than 10% of the transactions had cap rates greater than 10%. You talk about risk or ignoring risk, that was definitely the case. So with that said, where are we going? Well, we're off to a slow start. There's a disconnect between buyers and sellers, and illiquidity is still an issue. We are hopeful and we believe by the end of the year we'll have a little bit additional liquidity in the marketplace. And we also believe that that cap rate spread will have narrowed if not closed. Unfortunately, it's a buyer's market. So the sellers are going to have to meet the buyer's expectations on returns. Increased foreclosure activity. We've been talking with a lot of banks and a lot of special servicers. The special servicers are those who handle the CMBS loans. It's clear that we are at the beginning of the foreclosure process on the commercial side. That's the bad news. The good news is we don't think it's going to get anywhere close to as bad as the residential side. Lenders are going to have to finance their own transaction. That's going to be a trend that they're not doing it right now, but something we believe is going to happen as the year goes on. It might be the only way that they can exit some of these properties. And finally, package sales. If you're old enough to remember the RTC days, the RTC took pools of properties, put them together, and sold them to investors. Those investors made an absolute fortune on those deals. Look for that same opportunity to present itself in 2009. So what are the signs that our market's going to recover? Well, first of all, when these CMBS spreads start to narrow and that line trends down to where it was before. Now, you might be asking yourself, wait a minute, you just told me there are no CMBS loans out there. Remember, these are bonds that are trading, so there are yields attached to them. Better economic news. We're all tired of opening up the newspaper and hearing on the news about all the layoffs and everything bad occurring. When unemployment is stable, or when the employment rate is stable, and we start seeing these companies that have been doing all these layoffs post some strong earnings, that'll be a great sign for the real estate market. What about inflation? 10-year Treasury right now is trading at around 2.9%. The government right now is printing money to try to get us out of this recession. Now, I'm not an economist by any stretch, but my schooling tells me when you're printing money, there's going to be inflation. When you see that 10-year Treasury starting to rise, or you see people start talking about inflation, that'll be a good sign for the real estate market. So how do we sum up 2008 and 2009? Well, clearly 2008 was the end of the irrational exuberance, with 2009 being the return of the risk premium.